My name is Emma Channing. I am the founder of the SADIS Group. My words are my own. My background is that of an M&A and cap markets attorney, and I've been working in digital assets for the last 4 years. I wanted to take this opportunity to walk through some of the law, both sort of the regulations as well as some of the more recent case law and business and technology developments in security tokens, which are digital assets that are designed from the get-go to be securities, and also the current state of the SAFT, which is something that was used in 2017 and 18 to sell things called utility tokens and payment tokens. And the lifespan of that agreement and its ability to be used is really coming to an end, and I wanted to outline that scope. So, starting with security tokens. Security tokens are essentially the same technology as other digital assets, but they're designed to be a security and issued and marketed as such under Regulation CF, Reg D, or Reg S. When you do see a Reg CF piece, it is more often or not connected with a Reg D offering. Small changes are made and the Reg CF filings are done. Security tokens have historically been issued on a private or public version of Ethereum, utilizing either the ERC20 or the ERC 1400 standard. Couple of things to note about that. The ERC 1400 standard was built out to be a good standard for things that are securities. And that has a couple of flaws in its logic. Firstly, ERC20 is by far and away the most common standard at the moment for tokens. And so the vast majority of custody solutions are set up only to handle ERC20. And it is incredibly important to think about the entire life cycle of a security token when advising upon the structuring and issuance of one, both from a broker-dealer perspective as well as from a legal perspective. No one would keep thousands of dollars of securities and certificates at home in the safe. You know, you would keep them on your brokerage account. And there are very, very sophisticated custody solutions such as Gemini's, as well as Anchorages, that are set up to do security token custody extremely well. Anchorage in particular has a solution that's neither hot nor cold. The other tricky thing about ERC 1400 is it, I think, confuses the issue a little. When you're dealing with an ERC, there is no token, there is no actual digital asset. Doesn't have wings, doesn't fly through the ether. It is simply a line in the smart contract that says token 1, and there's a public address against that. And so even with ERC20, there's a vast amount you could do, because all you're having to do is change things at the smart contract level where effectively the token is living. The only thing that security investors in security tokens custody is in fact the private keys to the public wallet that's on that smart contract. Happy to answer a few more questions around that, because custody and control, settlement and clearing of digital assets is a very, very complicated area, and it does, I think, cause confusion and some misunderstandings. Obviously, when you are issuing under Reg D, marketing materials still need to meet the normal standards of good disclosure for private placements. The most common exemption for security token private placements has been Section 506C of Regulation D. The tricky bit about Regulation D and 506C is that it requires the issuer to verify that every single investor is an accredited investor, as opposed to self-certifying, which is what you can do under 506A and B. This is an extremely heavy burden. It's best handled by an automated platform with a broker-dealer on the end of that platform with Series 7 certifying that those people are indeed accredited investors. It's really quite a challenge, and I'll talk about that a little bit more on the next slide. Many have thought over time, including me at one time, that Regulation A+ is a good fit for security tokens. That's effectively a public offering. It's on a much shortened offering form. It's capped at 50 million, but it is a public offering. And I think the logic to whether that is a good idea is questionable, not least of all because there are no public marketplaces at the moment for security tokens to trade. Obviously, with NASDAQ's moves this year, we may see that change, but right now, all of the ATSs are only set up to do private security trading. What's more, although we've seen a significant number of security token offerings on Form A+ and S1 currently go through the process with the SEC, only Blockstack's offering of stacks has gone live, and that took significant effort. So it is perhaps worth addressing some of the key aspects of Regulation D in the context of security tokens. If you're practicing in a large firm, you're probably much more familiar with sections 506A and B for venture capital deals, and section 144A and Reg S for large issuances. For a variety of reasons, the security tokens that have been issued to date under Regulation D have been issued under 506C or 144A. And I'll get into that in a little bit. What I think is interesting to note is that we haven't actually seen any civil law jurisdictions dip their toe in so far. So far, governing law has been predominantly American, and if not New York, then Canadian or Australian. Diving into the joys of 506C, and it really is an unpleasant piece of legislation to deal with. Short of the recent changes in the accredited investor test, it's the last revolution in US securities law. If you're familiar with them, section 506A and B have strict number limits and rules around who the securities can be offered to. In particular, the investors must have a prior relationship with the issuer. However, they do allow some unaccredited investors to participate, and in particular, they allow accredited investors to self-certify. And that is the real rub when it comes to section 506C. Section 506C was designed to address the slow in the IPO pipeline, and it essentially mimics much of a public offering. And that's part of the reason why it's used for STOs, because you're looking for the ability to do interviews, the ability to do press releases, the ability to reach a wide audience, because it's such a new technology and a new way of investing. There are no limits to how many investors you have under 506C. And as I say, public solicitations can include websites and all sorts of other things that you can't do under 506B, as well as a direct reach out to investors without a prior relationship. The huge sting in the tail of Section 506C is that you are at the end of the exemptions. There is no other exemption to go to if you don't fully comply. And the challenge is that the issuer, and that's an obligation on the issuer, must verify that every single investor meets the accredited investor test. Now, the SEC has just recently proposed new changes to the definition of the accredited investor test and is going to propose that certain knowledge-based qualifications, including the FINRA Series 7 and 65 exams, will be sufficient to be an accredited investor. But historically, this has always been a blunt, do you have the cash to lose kind of test. And essentially that boils down to income of 200K this year and anticipated in the next 2 years, or assets of over $1 million, excluding homes for individuals, and 5 million in assets for companies. Fail to verify just one, and the exemption is lost, and it becomes an unplanned public offering without a registration. And that is very, very serious and a very heavy obligation. And that's why I said previously that this is not something you want to be doing as an issuer or a broker-dealer. You want this outsourced to a service provider who will guarantee that they will get it right and they will take responsibility if they get it wrong. So, golden question, why use security tokens? Security tokens offer interesting solutions. Originally, we all thought it would revolutionize how emerging growth companies raise capital. That revolution has been a little slower coming than we all hoped in 2016 and 17, but it gives the possibility of giving different benefits, both financial and otherwise, to security holders. For example, you can, rather than just give the right to dividends, you can give the right to a slice of income stream or some other benefit that makes the security more attractive. Another option is to give security holders preferred access to the services that your company provides, and or build a closer relationship with them, which is so important for emerging growth companies. From the issuer perspective, it allows you to have much better control over the capitalization of the table and compliance, particularly in regard to transfers. Another great use case are funds, particularly large funds looking to closer align interests with investors, particularly funds of liquid assets, and likewise it gives much better control for those funds. Both growth companies and funds can also benefit from the security token ATSs that allow trading, such as OFN, Rialto, T0, as well as just the possibility of building a bespoke bulletin board functionality. And indeed, some platforms like Securitize offer a direct access to several of those ATSs from their issuance platform. Security tokens also have a very strong use case where either the product or price discovery can be improved. And this is kind of where we're seeing the institutional interest coming in, particularly high yield debt, or where there's been historically back office issues in offering to a large number of investors, i.e. mini municipal bonds. Above all, in the time of COVID, we're all going through a transition to eventually what will be a new normal. And it's probably going to take months or even years to get to that new normal, but fintech is very likely to be at the center of that new normal. And fully digital securities, subscribed for, issued, managed, and traded online, completely socially distanced, without any paper, are an important consideration for that new normal. So this is improving over time, but I think it's worth just going over the legal requirements for STO service providers. Best in class compliance for advising on security tokens or other securities is a FINRA broker dealer license. Specifically, if you're going to structure a security token, I advise on whether those benefits come in, whether that income stream comes in, you need the 63 and you need the Series 79. To sell them, you need the 7. And likewise, to do the same things, you need the Series 50 or 52 for municipal bonds. Again, these things are changing. The more dubious providers of the past tended to claim that they could do all things, including providing legal compliance. And that's really not how it goes. You definitely want a full function international law firm or a specialist overseas law firm, unless you are exclusively staying within one jurisdiction for issuance and sale. It is impossible to state how important it is, particularly under New York law, to make sure that the tax is correct before you do the securities structuring. So both tax lawyers and accountancy lawyers are, tax accountants are incredibly important to getting an issue spot on. You're going to want marketing professionals, and then you are going to want an issuance platform that's fully digital, includes full AML, KYC, accredited investor verification, vital, as discussed, for 506C offerings, and suitability functionality for the broker-dealers, as well as access to a compliant ATS or bulletin board. There are several providers who do tick all of those boxes, but it is important to make sure that you are with one of those. Moving on to some of the developments that we've seen in STO offerings in the last 2 years or so. We have seen institutional interest slowly grow. In March 2018, JP Morgan made a groundbreaking test of Quorum, which was a private fork of Ethereum, with National Bank of Canada issuing and trading $100 million Yankee bond. The group of experimenters in that offering did trading, settlement, interest payments, all at groundbreaking speeds. August saw the World Bank's $81 million bondy and a second-year issuance at 33.8 million. In September 2019, Santander announced the issuance of a $20 million tokenized bond. This was an interesting approach in that Santander used the public Ethereum network for the issuance, which the argument at the time was redundancy, although I'm not sure I necessarily follow that logic when you're dealing with securities, but it hasn't been duplicated again. More interestingly, 2020 saw both Denver and Berkeley seek requests for proposals for mini municipal bonds. That's municipal bonds denominated much lower than the standard $100,000. Historically, this has been around $5,000, but STO issuance platforms can bring that down as low as 100. And that opens financial inclusion, that democratizes access, and that also keeps everyone safe. Again, a digital platform means social distancing, no paper, no risk of transmission. "2020, despite COVID, has been an extraordinarily busy year in terms of digital assets. And we've seen huge amounts of institutional interest. These 4 announcements that I'm going to walk through are just the edge of what has been announced and the possibilities that we're seeing. April saw DTCC release their Project Whitney case study, which was a blockchain-based prototype on the Ethereum public network while maintaining an independent digital record off-chain. They then proceeded at the back of the study to raise the well-known problems with public Ethereum, including slow transmission speed and high gas prices. But we're keen to be working with an open source protocol. June really saw the blockbuster news. NASDAQ announced its new marketplace services platform as well as its digital assets suite. It was built in collaboration with R3, Symbiont, and IBM, specifically Hyperledger, and it is aimed at a very wide asset class, not just STOs. The functionality is very significant, including issuance of assets and trading through pre-trade risk management, market surveillance, and official digital custody and settlement. There's not a lot of details around at the moment around how they're managing to do that or what they're doing it with, and how much of the interplay there is between Quarter and Hyperledger, but certainly a fascinating development. Then we saw in July Liquidity Edge and R3 having a banner year this year, announcing a plan to digitize the corporate bond market with a new trading platform, Ledger Edge. Ledger Edge intends to apply a combination of blockchain technology, AI, and secure enclave computing to improve liquidity by enabling discovery of prices and trades while preventing data leakage. Obviously, if for anyone close to that market, there are other providers doing that right now, and it is a very challenging thing to do that pushes against some applicable laws, but definitely an interesting development. The real kind of knockout news was on September 1, SGX announced it completed its first digital bond issuance on its digital platform, working with HSBC Singapore and Temasek, not exactly anything less than old guard, serious institutions. SGX launched a $400 million bond with a 5.5-year issuance and a follow-on of, again, Singapore dollars 100 million tap of the same issue issued by Olam International. SGX in this case utilized DAML. This is the smart contract language created by Digital Asset to model the bond and its distributed workflows. These moves, not just in the US but globally, the NASDAQ team is based in Sweden. This is a global move towards adopting digital asset technology for securities. And some are arguing that this will be the dominant way to issue securities within 5 years. So, to change pace, and turn towards litigation and not so great developments within digital assets. I want to talk about developments over the last 2 years, in relation to the SAFT. Cooley and Protocol Labs launched the SAFT in 2017 as a path for utility tokens. But the commentary was immediately negative, and everyone was unfortunately admiring of the initiative, which was to find some way to issue tokens that were going to be designed to just work on a platform and take investment and talk in terms of investment. But it just didn't get there. The idea of the SAFT, a simple agreement for future tokens, was that the SAFT would be a securities offering, but tokens bought through it would be not. A version of the SAFT was developed by Cooley and was posted online at the SAFT project, and it's still there. And many token sellers, big and small, used that version or others. But as I say, many raised issues about whether the structure or legal arguments in the SAFT paper worked. The Cardozo blockchain project issued a paper in 2017 entitled "Not So Fast: Risks Related to the Use of the SAFT for Token Sales," ultimately claiming that the legal analysis was flawed and that tokens sold pursuant to a SAFT were more likely to be securities than tokens sold without a SAFT. And that was really quite a foretelling of what was to come. And part of the reason why that argument was made was that if you have a situation where many of these issuers don't have general counsels, they don't have someone with a legal background on board, without enough supervision by the law firm in question, the issuers may feel that because they've been told that the SAFT works, they can make promises about the token and its ability to increase in value and or trade, which the SAFT would not save it from. And unfortunately, that was a behavior that was seen again and again, where essentially SAFT sales of tokens failed because of the manner of sale problem, where the nature of the SAFT basically infected the nature of the token through the way it was marketed, and the token was considered a concurrent offering along with the SAFT. The first complaint was addressed to the kick sale of a KIN token. The SEC had taken notice of the widespread use of the SAFT, and reportedly in March 2018 began subpoenaing many issuers, investors, and other market participants who had utilized the SAFT. As academic criticism continued, this indicated the SEC was communicating in private. They fundamentally didn't think the SAFT worked. Indeed, many market participants reluctantly stopped using the SAFT at that time, but not all. In November 2018, Bill Hinman, director of Corp Fin of the SEC, raised in his Gary Plastic speech in the last footnote that in his opinion, some, perhaps many SAFTs would fail to achieve their aim, and he encouraged anyone that has questions on a particular SAFT structure to consult with knowledgeable securities counsel or the staff. The first official shot at the SAFT from the SEC was in June 2019 in a complaint against Kik regarding the use of the SAFT for the KIN token sale. The complaint focused around Kik's difficult financial history, but also, as many had feared, the aggressive sales techniques used by Kik, confident that the SAF protected the kin tokens from security status. The SEC concluded that the SAF and the token sale were irretrievably merged in a single sale and that it was an unregistered public offering. The next major development was the EOS settlement and then the Telegram case. On September 30th, 2019, the EOS settlement was announced by the SEC. And then on October 11th, the SEC very quickly launched its complaint against Telegram's sale of TON, which also used a SAFT. The EOS did not. The settlement with the EOS was very complex, but again, essentially concluding that the initial EOS tokens were an unregistered security, but the current EOS tokens were not. It was a statement that token sales were always going to be securities in the eyes of the SEC, and that this was the direction they were taking. It's also worth noting that Block One, the company behind EOS, did negotiate a 506D bad actor waiver for all officers and directors involved. And I think all in the digital asset industry should take notice of that. That is the only settlement that has included that waiver. And a 506D bad actor status would prohibit someone from being involved in any capital raise as an officer at any point for the rest of their lives unless they apply for a waiver. Less than 2 weeks later, the SEC issued its complaint and application for a preliminary injunction against Telegram. The significance was Telegram's size of offering, 424.5 million, and its relative sophistication. The complaint was relatively similar to Kik in that it argued that the SAFT and the token sale were intrinsically part of one scheme, which met the Howey test as an investment contract, primarily based on the manner of sale. This mostly focused on interviews at conferences and things said in phone calls, again, by the founders of Telegram, not with their lawyers with them, talking about possible accretion of value in the TON token. The real death knell for the SAF was that the Telegram preliminary injunction was awarded in the Southern District of New York on March 24th, 2020. For all of you not familiar with the glories of a preliminary injunction, it is very, very hard to win having lost a preliminary injunction. The judge will have decided that the case is likely to lose on the merits, and that is the basis on which the preliminary injunction is issued against a defendant. Telegram thought about fighting for a short time, but then settled on June 26th, agreeing to return 1.2 billion in the total amount of raise to investors and to pay a 18.5 million civil penalty. A sorry end to 2 years of hard work by Telegram. Finally, it's worth turning to where Kik is, as well as the unicorn case. The Kik case is continuing, but another fairly aggressive settlement was reached on another SAF sale, which is the unicorn case. Kik proceeded in 2020 through attempts at summary judgment. These were heard on July 9th, 2020, but strangely enough, some 2 months later, we still haven't had a decision from the judge and no reason given why. And that particular judge is usually pretty quick, within a week, in terms of issuing judgments. So not quite sure what's going on there. On September 15th, the SEC reached agreement with Unicorn to cease and desist. Between June and October 2017, this is 3 years ago at this point, Unicorn raised approximately 31 million through its offering of its UKG token through a SAFT. The order finds that Unicorn planned to use the offering proceeds to make more futures available on the gaming platform and develop additional applications for the UKG tokens. Again, unfortunately, Unicorn team members promised investors that it would facilitate secondary trading for the tokens, and efforts to increase usages for the token would increase demand and in turn increase value for the tokens. That manner of sale is, as far as the SEC is concerned, enough to make it a concurrent offering and essentially a single offering of a security. Unicorn agreed to pay a penalty of 6.1 million. It is worth mentioning that these are considered to be the total assets of the company at this time. The order establishes a fair fund to return this money to injured investors. Unicorn also agreed to disable the token, publish notice of the order, and request removal of the token from all digital asset trading platforms. There's two things worth noting about this. Initially, when the SEC began its series of subpoenas and cases, essentially the 21A DAO report issuance date on July 25th, 2017, which was the first words from the SEC on token sales, was considered a soft line in the sand, that if you were over that line, then you were likely to be subject to litigation. But if you started before, then you should probably be in the clear. The Munchie order, issued in December 2017, is considered a hard line in the sand. But in this instance, they had begun in June, although the entire offering continued through October 2017. So this is a question now in my mind about really whether that soft line is there at all anymore. Secondly, although you can read and piece together the logic, the order doesn't even have a discussion of why the SAFT failed. Just mentions the facts, and the order assumes that it does. And there we go.